Hi, and welcome everyone for joining our webinar. Thank you very much for taking the time to join us tonight or today, depending on wherever you are. We're still having a few people joining us, so I think we're going to wait another 1 or 2 minutes before we start. But in the meantime, I'm just going to very briefly run you through the program for today, and I'll introduce our speakers as well. Now, today we're going to cover a few points regarding the development of the futures market for container freight futures in particular. And we have 2 guest speakers today joining us from Linerlytica. Next to me is Johnson Leung. He's the director of Linerlytica. He is an expert when it comes to all things data related to container freight futures and the container freight market overall. And so he's going to be introducing the current market situation, covering a few hot topics in recent weeks, especially topics like freight capacity and the relation to spot prices as well. The second speaker is going to be me. I'll simply be introducing futures in general as a tool for hedging, in particular, container freight exposure. And lastly, we're going to have Peter, who is joining us from Braemar. And he's an expert when it comes to the FBX market in particular. Braemar is also an interdealer broker. They basically make sure that the market functions smoothly and connect buyers and sellers of freight futures again as well. And he's going to cover a few trading opportunities, in particular when it comes to connecting the IDB and the FBX and the INE EC markets. Now, to start, I'm going to go ahead and quickly share my screen, and we'll set off with the presentation from Johnson. I'm going to share the screen. Okay.
All right. So, hi, everyone. So, thank you, Vince, for having me. So, Peter, pleasure meeting you. So, yeah, look forward to a good session together. Okay. So, I think today's what I will go through is quickly the overview of the market, and then a point that I would like to convey recently to in every meeting. This year's entering this year's lots of people look at the headline capacity and call a bear market. I mean, of course, the Red Sea situation is something that no one would have expected. But after the Red Sea happened, we have seen what happened in January. So about the diversions of the liners vessel to from the Red Sea or Suez Passage to Cape of Good Hope. So you kind of get a sense of the impact already. However, the market is still very stubborn and decided that, I mean, one, of course, no one knows how long the Red Sea situation lasts. And secondly, so that's actually a point that I think is more strongly implanted in everyone's mind is so this 9% or 8% headline capacity growth. So although various analysts make estimates about the diversion may take away between 6 to 9 or from MERS around like low teen percentage point of global capacity. But then those are estimates, right? So people find it hard to replicate. So that our mindset tend to actually look at what we could see. And order books are very transparent. We know about the delivery of the new ships. So we still hang on to this 9%. So hence, when the first quarter result come out and then the recent rally of the freight rate happened, the management from various liner companies, they mentioned about being surprised. So here we go. That I mean, the topic today is about the FIG futures. I call the one listed in Shanghai's COFIF, COFIF, stand for Continuous FIG Index Future. So as it stands now, so you look at the chart here. So the dark blue line is the COFIF, the FIG futures prices for the day that we see in the x-axis. And then the red one here is the spot rate. The FIG future tracking this thing called SCFIS. So many of us are familiar with SCFI, which is Shanghai Container Freight Index. But this SCFIS is a new thing, so it's only been around for a couple of years. The S here stands for settlement or settled. So basically, this index is tracking the FAK freight rates so that the Shanghai Shipping Exchange found on the bill of lading. So meaning this index are the freight rate that usually happen for shipment that had left last week in Shanghai. And SCFI is the index from a panel, so they're talking about freight rate being quoted this week. So usually, so SCFI is about the freight rate in the next week or two. So SCFI is actually a step ahead of this SCFIS. But this SCFIS is the underlining for the COFIF. So spot is here, and then the futures here. Spot is around 3,000. Future now, this data points are closed on Monday. So around 4,000. So it's around 30% higher than the spot. So this is index. It's not fixed rate. So the ballpark I use probably about you multiply it with about 1.5, 1.6. So 4,000 here is equal to somewhere close to 6,000. So that is the future. Oh, one more point. The future here is not just about one contract. I combined the April contract in most part of it, and then the June contract, and then the August contract. So because it's, the so-called the main contract's been shifting. So when April closed, then the shift to June and then August. So anyhow, so the current contract, that's the main contract, is August. So August 6,000. So comparing to the spot is 3,000 here, so equivalent to somewhere around probably about like 4,500. So which is the spot last week. So it's about right. But 6,000 for August, so because we know that already at the moment the liners are quoting around 6,000 is for 40-footer. 6,000 for 40-footer to North Europe. So 6,000, staying 6,000 until August, it is unusual. Freight rate either go up or down. It won't stay flat for 2 months. So something's wrong. So it could be higher, or could be lower. I mean that. But anyhow, the future trading at a significant premium to the spot. Another point I like to highlight for people looking at the chart here is here the bottom is the lighter color is the turnover in value, US dollars per day. So the turnover values in a day. And then the darker colors are the so-called open interest, meaning the position that people held overnight. You look at the total amounts, the OI, the open interest, actually is back to this contract. I mean, this market's all-time high. So similar to when the Red Sea has just happened. And the open interest usually, so my experience of observing this this market is very telling. When the trader has the conviction that they tend to hold market, so I mean hold the position overnight, and then it shows the strength of the rally, and then the open interest usually they go hand in hand. So one point to point out also for the coffee markets, the exchange is very cautious. So anytime the market rallies, they would have a various kind of market cooling measure or the risk management to make sure that the traders not overstretching themselves. So this is certainly the bull market here. So although it seems to have some hesitation when after you hit the peak, but still you have to look at this in the context. The exchange have done various things to try to cool the markets when this rally is happening. So that's the current state. What people look at the future and the current. And then a couple fundamental points about utilization, capacity, and the implied volumes. Those are the things that in Linerlytica that we track frequently. So the utilization here is actually it's a draft based, so it's about the loading. So it's not totally equivalent to the slot utilization. But anyhow, I can explain the methodologies in another time when some of you are interested. We're going to do the webinars a couple more times, right? So some of the data point we can get down to a bit more basics. So a big trend here is that the utilization has actually been trending up. In fact, it's been trending up. So even before the Red Sea, certainly the Red Sea is taking another notch higher than last year. Then the capacity, so up until recently, at this point, and then you comparing to the similar, about like week 18, week 19. So it's not much higher in the Asia-Europe trade. So next few weeks, those are the projection, the lighter color, likely move up. But comparing to around the same period last year, it's also not super high either. So I will get down to the actual figures about what is really the capacity growth on this weekly capacity counter. We tend to look at the weekly capacity because it's different from the deployment. Deployment is about, for the entire market, the industry put in a few thousand, like 2,000, 3,000 vessels, and then you have in total, like a couple millions of capacity in the Asia-Europe trade. But the weekly capacity is the effective capacity. It's a capacity figure that the shippers, meaning the cargo owners, see every week, so that they could book. So this is what we call the weekly capacity. And weekly capacity is a figure that also take into consideration the voyage time. So longer voyage, even though you put in more vessel into the same market, and then it will spread thinner. So the weekly capacity will show up smaller. So and then the implied volume. So volume-wise is not super spectacular. So a lot of these come from actually those capacity drop. So especially what we see in the last couple of months. And then the liners, the quotations okay, I need to acknowledge the data source here in this chart I will add is from the gig rates, Chinese providers. I think the downloads a bunch of FAK quotation from various liners. So currently, I break them down into 40-footer here and then 20-footer the other side. 40-footer, you could see what's being coded in the 2M from different liners. So these colors are from CMA CGM and members, and then from the Ocean Alliance and then the Alliance. So individually, we could see, have a good view from here about what exactly is being coded as FAK from Asia to Europe. So most, the liner now, the CMA CGM, and then here's the like CMA CGM, they're coding around 6,000, but then like one's clearly an outliner here, they're coding 8,000 already. So my bearings, this FAK that we have seen up until May 20, 2 days ago. So it is already coding what they call the 6,000, the June rate, and some of them even exceed it. But then you could see the periods, the future traders are trading at around the equivalent to 6,000 for 40-footer. So I'm not taking credit away from the future trader. I do see that they have moved like every turn of the corner, so they actually move a step ahead of spot, meaning they read the market slightly better than the physical market. Anyway, so those are the current state of the market. So clearly, it has been the market has been bullish. Of course, I have to make a remark here. It really depending on how long the Red Sea will last. So it is hugely volatile, risky, and then freight rate is unpredictable. So those are the main point. I think that the next two speakers that we talk about, hence the trading of the future. So, okay, so one point I want to also pass on, so we talk about what is really the headline capacity and the actual capacity. So this year, we have this data series go back to the 80s. So around over 4 decades of demand and supply. Usually, the difference is really a few percentage points. It's not a huge gap. But then obviously, since year 2010, the demand growth here, I take an average and a straight line here. So it's It's definitely a step lower than what we have seen the previous 3 decades. So the world changes. The containerization finishing, so the outsourcing, so one is cost. So we are down to container shipping demand growth more kind of in line with the global GDP growth. And then, I mean, you look at this year, the capacity, because it's during the COVID times, the liners ordered lots of new capacities that are due to be delivered this year. So you have a 9% capacity growth, I mean, the so-called nominal figure. So definitely it's scary. It's a 9% growth in capacity, only around 2% growth in demand. So I mean, demand growth is our own estimate. So anyway, this gap is what make a lot of analysts and also the liner management bearish. But those are the things that we observe. So I explain a little bit. So this is a very busy chart here. So these are 4 main east-west trades. So the sign, the Far East to West Coast US, Far East to East Coast US, and then Far East to North Europe, so Far East to Mediterranean. So those are the weekly capacity. So those are the figures that we see on I mean the shipper could book. So also what we call the effective capacity. And the middle table here, so we see the total capacity deployment. So globally, so in the bottom here, so you know the liner shipping is around like 6,500 vessels, around 29,000 million, 29 million TEU totally. So this year up until this data point, I think, yeah, this whole chart. So it's I took it from the data about earlier this month, so beginning of May. So the capacity growth on a year-on-year basis in terms of deployment, 10%. So, but individually, so for a couple of traders, especially in North Europe, right? So you see that the capacity growth totally 17 or 18% more capacity being deployed to Asia-Europe trade. So from probably it's around like 220 ships to now it's 260 ships. So 18% deployment growth. So that's a headline capacity growth. But the weekly capacity is actually down by 3%. So that's based on the early May data. So and then we look at the trade to Mediterranean. So the capacity growth or deployment increases up to 45%. But then the weekly capacity is actually down on the week that we see, so 2% down. I think up until recently, this data points about freight, and this one's similarly. So the recent weeks, the one that we published on Monday, is still down on a year-on-year basis. So the difference between the deployment and effective capacities, there's a huge delta, which is I mean, this year it's a transit time. So the turnaround time of vessels is much longer. So for example, for Asia-Europe trade, it used to be about 90 days a round trip. Now it's nearly 110, and some of the ship even 120 days a round trip. So you can imagine for a 10,000 TEU ship, when usually the round trip 90 days every year, you can carry 40,000. So you can do 4 trips, right, from Far East to Europe. So 40,000 TEU. But if your transit time extended to 120 days, meaning you only can do 3 round trips, then your capacity reduced to just around 30,000. So hence the deployment and the weekly capacity is different. So to North America, there's some efficiency gains, less congestion, certainly. So we see that the deployed capacity actually is to North America is slightly lower than the effective capacity. So those are the 4 main trade, and then the next chart here I show is nearly globally. So what I say nearly globally because it covers all the main line. So all the basically what I call the trans-regional trade, the long haul. So year to date last year, on the weekly basis, this figure is around 2 million TEU in all this trade, in the head haul. So 2.06 million, but this year is 2.04. And then we look at the week on week, so those are the year-to-date average, right? We look at the last week's figures. So actually, it's 5% lower year-on-year. Just think about it. Everyone talking about 9% capacity growth, but on the weekly capacity basis or the effective capacity, it could be down. So that hence I think, but then of course it's I think even if I said so the market is still hang on to the 9% because that's the one that they can replicate. You'll say, oh, Johnson, your 9% drop you could not replicate. But then it's not projection, gentlemen. So this one is really what has happened. So it's historical figure. It's not my projection. And then another point that I want to convey is so you can see the headline capacity and the effective capacity growth, it could be hugely different. So another point that you can look at is, so if you look back, we start to track this data, so this utilization is based on the draft, meaning that the loading of the vessel. So since the end of 2020, so I mean, definitely utilization been moving up since the middle of last year. But the main point I want you to take away from this chart is, over the last few years, from the bull market to the bear market, you could see the utilization difference is only about 5 percentage points. So when you're making, you based on a projection 9% headline capacity growth, and then you turn out to be flat or even lower. And then there's actually a turnaround nearly 14 percentage point. So that's the demand supply estimation is hugely inaccurate in that sense. So and that's why you cannot really just base on that to call the market. So because the utilization bull to bear market is different, it's only 5%. So your errors are 1 percentage point or 2 percentage point difference, then the picture totally different from a bear market to a bull market. So that's why. So we think I think for this year, instead of, I mean, in 2020 to 2022, people call it the COVID cycle, and then this year people may go away and call it the Red Sea year or the Hutu year, the Hutu surprise. But I hope that for people who do container shipping data analysis, you remember this year as we had the headline capacity too much year. Just remember that figure cannot be totally relied on to make decision. So that's our point. I stop here.
Okay, thank you very much, Johnson. And with that, it's going to be me to discuss a bit about the container freight futures contract in a bit more detail to explain how it actually works. First of all, I want to point out one more thing. We're obviously going to share all these slides with you later. So no worries about that. And if you have any questions at any point, just feel free to put those in the chat as well. We're going to have a bit of a Q&A afterwards if we have any questions. So just, put them in there and we'll address them later, obviously. Now, let's continue right away here. In the end, the case for container freight futures, based on what Johnson already explained a little bit, is actually quite a simple one. There's really 3 factors that we need to look at that can explain why freight futures might be attractive. The first one is predictability. Essentially, freight rates can be very unpredictable. I don't think I need to go into much detail to explain why that might be. But with futures, it is possible for physical users, so that's liners, shippers, BCOs, etc., to essentially lock in freight rates and make them more predictable. The next thing is transparency. Futures have the ability to essentially provide price transparency. Right now, the liner market, for example, is significantly more concentrated than the market on the other side of that equation. So that means people have different amounts of information. They might not be able to see the same amount of data. They might not be able to have access to the same sources of data. And so pricing can be a bit unclear, especially for smaller participants. Futures do have the ability to essentially provide a very easy to see price for everyone in the market. And people can essentially use that price as a reference or even as a price for physical contracts as well. Lastly, you have enforceability. This specifically relates to the contrast between futures and over-the-counter or OTC contracts, because futures, exchange-traded futures, I should say, are traded on regulated exchanges that have a centralized clearinghouse. And this exchange is going to act as the central counterparty for every single buyer and seller. So that means these trades are actually enforceable. So that means if you buy a certain contract at a certain price, then if the price moves in your favor, you are going to get your profit. And the exchange is going to make sure of that. Now, continue on to the next slide. I'm going to give you a bit of an overview of basically what the futures market looks like, or what kind of contracts they are, and how they actually work, where the prices come from. Currently, all these freight futures contracts are settled financially. That is, there's an underlying index, for example, the Freightos Baltic Index or the Shanghai Shipping Exchanges SCFIS Index that Johnson already mentioned previously. And they essentially take prices from the physical market. And ultimately, the final price of the futures contract is simply going to be typically an average of this underlying index price in the previous weeks, for example. And so ultimately, any profit and loss is settled against this final price. So that essentially provides the linkage between the physical and the futures market. This is what sort of makes sure that the futures market doesn't just randomly move away from the physical market, and they stay together. Apart from that, the contracts differ in quite a few respects. So there are obviously different routes. The indices are composed differently, they are calculated differently, and the exchanges also differ themselves. They might have different trading hours. The contracts can be traded either electronically or through interdealer brokers. Obviously, different contracts also differ in liquidity, and they have different market participants. All of these are things that do affect how easy it is to use these contracts, and also where the price is going to be for those contracts at a certain point in time. Now, just to give a very quick overview of what actually is available right now, there are currently 3 exchanges that offer container freight contracts. And you have one in China, the Shanghai International Energy Exchange, or INE, and they have one contract right now that is a Shanghai to North Europe containerized freight contract based on the SCFIS index. And then you have the Singapore and Chicago exchanges. They both have contracts based on the Freightos Baltic Index, and they're the so-called FBX contracts, and they have a number of routes here available. So essentially, right now on the Chinese side, you have only one contract. On the international side, you have a number of different contracts. Some of them are covering similar routes. So you also have the China, East Asia to North Europe route, for example, but you also have additional routes, especially on the Chicago side, that cover both the voyage from Asia, for example, to Europe, and the return voyage as well. Just to give a bit of detail on the underlying index, the FBX is essentially based, or it's calculated a bit different from the Shanghai Shipping Exchange Index. It's based on a sort of rolling window for FAK spot rates and rate surcharge as well. So it's, again, sort of all-in price. But this price here represents a specific USD per 40-footer price. So that means one contract is simply the equivalent of one 40-foot container. On the SCFIS index side, it's a bit different. The index there is composed of both 20-foot and 40-foot rates. So that means the index is not exactly equivalent to a specific price of a 40-foot or 20-foot container. Instead, the index is essentially more of a sentiment index. It's a sort of, it gives you an overall picture of where the market is, but you can't convert it one-to-one to a dollar price. The contract for the INE's Shanghai to North Europe contract is simply calculated by multiplying the index value with 50 RMB. So that gives you essentially what the contract itself is worth. So that means if you were to hedge something with that contract, I'll go into a bit more detail on that later, you essentially just use the value of what you're hedging and the value of the contract to find out how much you would need to hedge. Another thing here to mention is that the SCFIS, again, as Johnson mentioned, is not the same as the SCFI index. They are 2 completely different beasts. The SCFIS was launched, it's quite new, was launched in November 2020. And it is actually based on bills of lading. So that means the prices reflected in that index are actual prices that have been paid in the market after the ship has left. So they get recorded and ultimately make up that index that is released at 3:05 every Monday. So this index, again, different from the SCFIA. And the FBX and INE EC contracts are, again, both cash settled. So that means if you buy the contract, ultimately, you will not receive any physical cargo space. Simply buyers or sellers will ultimately receive financial compensation for the profit or loss that the contract has incurred. So there is no delivery, essentially, of the underlying freight space. Next, there have been previous attempts at launching futures contracts. And when I say futures contracts, I should put that in quotes, because the contracts there were never really proper exchange traded contracts. They were launched on non-financial exchanges. They were not regulated. And that is why they ultimately failed, because they didn't have the essentially back up the organizational know-how of a proper futures exchange to actually make sure they are well organized and well executed. And ultimately, they also struggled with low liquidity. So that means there simply weren't enough people in the market that were actually trying to buy and sell. And ultimately, if you don't have liquidity, it makes it very difficult, especially for hedgers, for example, that may have large positions they would like to hedge, to go into that market and take or close a position. But again, this is where these new contracts are different, because especially the Chinese market is a very, very liquid market. And now that you have both the Chinese and international exchanges offering these contracts, you basically are connecting hedgers, speculators, and people in different markets in different locations. And they can actually access these exchanges through a broker like Bands, for example, to trade everything from a single account. And it's very easy to go from one contract to the other contract. And Peter is actually going to go into a bit more detail about how that might work specifically. But fundamentally, there are really two differences. One is these contracts are all regulated, and there is now liquidity in these markets. So it is possible to actually open and close large positions. Now, there's a bit more detail I would like to give on the EC contract, just as an example of how a futures contract might work. Again, as I mentioned, it is the index, the underlying index, is composed of both 20 and 40-foot container prices. So the price there is essentially an index price, not a one-to-one reference to a specific container price. The settlement price is then determined by the underlying SCFIS index. So essentially based on the previous week's actual bill of ladings, you then get a price that is used to settle the contract financially. So that means in June, for example, the settlement price would be the average of the SCFIS index values released on the 10th, 17th, and 24th of June. The INE is also a bonded exchange. So that means even though the exchange is located in China, if you're trading it from overseas, you're actually trading in a bonded area that is not subject to Chinese taxation, for example. And all these contracts as futures contracts also have essentially an initial margin. That is to say, you don't actually need to put down the full value of the contract. You would typically put down a percentage of the contract value. So for example, at the moment, that might be 17 or 18% of the contract value that you would essentially put down to open a position. So that means if the contract is worth hypothetically $100,000, you might put down 17 or 18,000 US dollars to actually open that position. The rest of the money you would ultimately only need to exchange based on the profit and loss that the contract makes once it is settled. And lastly, I want to emphasize again that in all of these contracts, the exchange acts as the central counterparty. And so that means for every buyer and every seller, the exchange is the counterparty, and the exchange guarantees that the profit and loss is actually settled. I've got a few more details on the contract here. As I mentioned, we will share those slides with you later. So if you want to go into more detail, you can take a look at this slide afterwards. But here we can just take another look at how the market has actually developed in recent times. Now, as Johnson has pointed out, the EC market actually is quite fast to actually respond to changes in the sentiment. And to a certain extent, it might even be faster than the underlying physical market in reflecting the situation on the ground. This also means that the SCFIS index has been rising a bit slower. So when you're using this for hedging, it's important to pay attention to where the market is relative to the physical market and make sure that you're not caught out on the wrong side of that, basically. Apart from that, it's also important to look at things like open interest and all that. You really have open interest as sort of indicator of how convinced traders are that the price is essentially going to continue to rise if you are in a positive market. So that means if you have more positions that are open, people essentially buy and sell, and they keep these positions open. They don't just close them in the same day. And so that essentially is a sign of conviction in a futures market, typically. And you've had that in December and January, as well as in April, May recently, when, again, this was accompanied by a very strong price rise. So yeah, these are a few things to sort of pay attention to when you are trading this contract. Aside from that, one thing, again, you might have noticed is that in January, February in this chart, we look here on the right side, trading volumes dropped quite a bit. This was simply because trading volumes really exploded around the time after the Red Sea crisis emerged, and the exchange essentially clamped down a bit on the speculative inflow of especially smaller traders that might not always be able to meet the initial margin requirements ultimately. So the exchange made sure that those traders essentially don't break the market in a sense.
Oh, can I add one point here?
Of course.
Yeah, the chart here is different from the open interest and the turnover chart I showed us. The one that I show is a monetary value, so US dollars per day, and this one's how many lots. And another point I'd like to add also is that the quiet period, although is much lower turnovers between end of January to end of March, but it still trade in the US dollar terms over 100 million US dollars a day. So which is quite significant. I mean, sufficient for the industry to make use of it if they want to do hedgings on this instrument. So then obviously the lower volumes also not just because of exchange, but also that period is absolutely we're entering the kind of a slightly market thing. Okay.
Certainly, yeah. So in a sense, this is also reflected again by the price. The price has been relatively stable, and ultimately people like to trade when there's something happening in the market. So that's why you have people moving into the market when the price is rising. And when there's not much going on, essentially, the market usually calms down a bit as well. Now, when it comes to hedging, the idea here really is to basically offset a physical position with a position in the futures market. So that means any profit in the physical market would be offset by a loss in the futures market. And it's very important, I think, for physical guys, especially to understand this. The idea of using futures to hedge does not mean you're trying to increase or decrease your profits necessarily. It's really more of a risk management tool. You're essentially trying to reduce the risk of sudden market price fluctuations. So ultimately, in an ideal world where the futures and physical markets move essentially in perfect synchronization, you would really have in any scenario where you have a beneficial price movement in the physical market, you would then lose money in the futures market. And so the effect would be that essentially this loss is offset, and ultimately you are getting the price you locked in with your futures contract. So again, this is different from prop trading, where you are trying to take a calculated risk based on your research to then essentially make money off of that and essentially increase your earnings. But this is separate from hedging, and it's very important, especially for people that haven't been active in the futures market, to understand this. Now, I have two examples here. I'll go through very briefly, just to show you how you might calculate a hedge, essentially. In this case, we're just going to assume we are a liner in the physical market, and we have, for example, 5,000 40-footers that we would like to essentially sell at a spot price in August. Now, in this case, we are essentially at risk if the spot price falls in August. Thus, in order to offset this physical position, I would then like to enter a futures position where I would earn money essentially if the price falls. So therefore, I would essentially sell or short a August futures contract. That way, if the August futures contract, if the price falls, the futures contract is going to earn money, while my spot sell price in August is actually going to be lower than what I could be getting right now. And so ultimately, these two will offset each other, more or less at least. And I will essentially secure the higher price. I will lock in the higher price that is essentially in the market right now. So just using essentially more or less recent numbers, we can take a look at the current spot rate. Let's say we have a current spot rate of around 4,900 USD. Again, with a capacity of 5,000 40 footers, we then simply multiply those two together. And then since the contract is traded in renminbi or CNH, you would then obviously need to adjust for the rate as well. But ultimately, the value that we're hedging would then be in renminbi 177 million approximately. To hedge, essentially, using the EC contract, we want to hedge this value here, not a certain amount of containers. That's important to understand when calculating these numbers. And so essentially, if I want to understand how many lots, how many contracts I would need to buy or sell, I would simply take this number that I want to hedge, divide by the current market price of the August contract, and again, divide that by 50, which is basically the contract multiplier. So that just gives you what the contract is actually worth, as opposed to the contract points that it's trading at the moment. And that gives me a value of around 855 lots right now, 856, since we're rounding up in this case. Now, assuming the spot market then falls to around 4,700 in August, this means the hypothetical liner would make a loss in the physical market. However, in this case, since the SCFIS would also fall, given that settled rates would be lower, the futures contract will also settle at a lower price. So that means your short position in the futures market would actually earn money. So looking at this chart here, we can take a look at the numbers here, and we see that while in the spot market, I would lose here about 1 million USD. In the futures market, I would actually gain 1.35 million USD. And while at first you might say, well, that's great, I just made even more money than I would have, the important thing to note here is that this can go either way. The futures market and spot market, they are linked, but they may not always move one-to-one. For every percent that the spot market drops, the futures market might not also drop exactly 1%, and the price that you specifically get in the spot market might not be the price that the SCFIS ultimately settles against. So that means ultimately these futures are a risk management tool. They are not a panacea that can basically offset everything automatically. And it's important that when you are trading these contracts, you are essentially paying attention to what's happening in the market, and you understand how the ultimate payoff is going to work in the futures market. I have another example here for shippers. It's essentially for shippers. It's the exact other way around. You would benefit from prices falling in the physical market. So to offset basically the loss of prices rising, you would then buy a futures contract. And the calculation, again, is the other way around. And in this case, you can see if we take the same numbers here, you might even lose some additional money in this case compared to if there was a perfect hedge where the two would offset each other. So it's important to pay attention to how you are applying all of these contracts, all of these futures. And there's a bit more that goes into this than just looking at the futures market. Obviously, there's FX exposure, and there's interest rates to take into account as well. So there's a little bit more to it, but as a very basic overview, this is more or less how it might look like. Now, aside from that, for the traders here, there are a few ideas regarding calendar spreads. In the interest of time, I'm not going to go through this in more detail, since I think we also want to hear from Peter next. So I just want to mention one more thing very briefly. We have a trading competition. It's a virtual freight futures trading competition for basically anybody who's in the physical industry, but also financial industry participants who want to try it out. It's completely free to join. Again, as I said, it's a virtual competition, so there's no actual risk involved there. The only benefit is to the upside, since you can actually win the actual futures contract here. and it's going to be starting in June. You can sign up at the link here, and it's basically an opportunity for anybody who is interested in trying out these futures contracts and to see how they work, to just do this in a safe virtual environment where there's no risk of actually losing money in case you're not fully understanding how it actually works just yet. So yeah, please feel free to sign up if you're interested, or reach out to us later if you have any further questions. And with that, I'm going to hand over to Peter now.
Thanks for that. I think you've done a really good job just giving us a good overview of everything. You may run into some overlap with what we have. I'll try and get the sharing sorted. I don't think it's working, but let me just check. Should be fine. There we go. Perfect. So yeah, I mean, going through this, very much the same sort of mechanisms, right? You were speaking across the indexes. I'm obviously involved to try and engage the international market. I think one of the really good things that's developed over the past 6 months or so has been the volumes in the onshore markets and INE, which has sort of dispelled some of the myths that have surrounded support for these kind of markets, and also solidified some of the cases in terms of the market coming into hedge and to trade, which is something the market has wanted for a while now. But as I've mentioned before, there have been a couple of attempts over the past 15 years or so, and it's finally coming to a fore. So really excited to get in front of it and try and demo some examples. Do have a disclaimer here. Obviously, you'll have this this presentation along with the stack from bands after the call, so you can have it wherever you need. So you can revert to this. Essentially, obviously, we're dealing in freight futures and derivatives contracts, and so there is risk of loss. But essentially, you're dealing with hedging, so you will deal with situations where you're looking to offset where you're on the physical market. In terms of the market itself, I'm primarily focused on introducing the FBX container futures. The primary differences that we've gone over before are you're dealing with a US dollar versus a renminbi denominated contract. Essentially means you're dealing with two different currencies. Generally speaking, we find that a lot of the European, North American markets prefer the US dollar market, but obviously we've over the past couple of years been developing liquidity at a much slower rate, shall we say, than the INE markets has been. One of the positive things that we've identified out of these two markets is the ability to essentially cross volumes from the INE into the FBX trading markets on the SGX and the CME. We've got a nice graphic here just to demonstrate what is available on the Singapore Exchange and the Chicago Mercantile Exchange. You've essentially got a list of 6 routes, 4 routes on the SGX that provide a bit more scope in terms of what you can hedge. But I'm almost certain, there is a US contract available on SCFIS on the SHIFI that will probably, I assume, become available on the INE at some point in the future, given the positivity around the volumes on the Asia-Europe contract. Primarily speaking, we're looking at a difference of points versus US dollar per FEU. You can, as was shown in an example before, you can essentially work out what the points value would be in US dollar. On the FBX, it's a bit more straightforward. You're plainly looking at what is the dollar value per 40-foot container, including all of the surcharges and ocean freight. So that includes bunker adjustment factor, includes peak season surcharges, includes GRIs. All these things all get caught up in the FBX rate. And as I mentioned, listed on 2 exchanges, one in Singapore and one in the US. The primary focus point and why we identify a massive opportunity on the basis of the success of the INE has been the correlations between the INE's underlying indexes, so the SCFIS Europe service contract, and the FBX. So the FBX route of choice at the moment would only be FBX 11, which is China, East Asia to North Europe. And generally speaking, carries very high correlations. The last study we did was around 98%. So you've got a really solid correlation between the underlying indexes. Can change depending on time of study and basis risk. And you generally see maybe a week time lag between the SCFIS EC and the FBX 11 as an example. That obviously means that hedging is available on both the INE and the FBX. The primary driver we'd see for someone engaging on one or the other is generally based on geographic location rather than anything else. We'd obviously know that a lot of the volumes on the INE will be inside of China. It is open internationally, but we would also say, well, there are plenty of avenues across the globe now where you can take advantage of this, and the volumes are available wherever you look. The way we have that available is through arbitrage trade between the INE and the FBX. So that lands either on SGX and the CME. It doesn't really matter. It's really dependent on where you have access to these markets and where you sit geographically. But essentially, I'll show in a chart in a minute, you're looking at contracts that can trade volumes off of one exchange onto another based on either some kind of profit dynamic, and there is a very clear profit dynamic at the moment, which I'll go into, or because you want to say, well, I need something in US dollars because that's how my treasury functions will work, or you want it in yen, therefore you'll be dealing on the INE directly. So this is a nice chart. So if you have Bloomberg and you're watching, you can pull this up yourself. We've generally overlaid the FBX 11 China to Europe contract index against the INE June 2024 contract and its price action. So you've got the initial period here, which everyone will recognize, which is COVID-19 pandemic, where you see the massive rise in freight rates up to never before seen highs, which comes off around midway through 2022 and then normalizes throughout 2023. And then you get the launch of the INE in September last year, which starts off the contract on the INE, and the June contract generally prices in a trend in line with the physical market. You've got the event that happened, sort of triggered the buying in the market and the spiking in freight rates, which was the attack on the Galaxy Leader vehicle carrier in November of last year. And then you've obviously got massive buying both on the physical and on the futures that's directly in line with each other. So you see a nice parity between where the physical market is going and where the futures market is pricing. What's already been traded on the SGX, so this has already happened once, is an arbitrage between the INE level, because we've seen very, very strong buying on INE SEFIS June throughout, let's say, the past couple of months. And that's just sustained and sustained and sustained over the past weeks, where we're now looking at prices that are roughly equivalent, at least according to charting like this, to the highs of the COVID period, which is exceptional price action. This is well ahead of the price levels that you find on FBX. So we were fortunate to trade an SGX contract yesterday. The June price was $5,650 per 40-foot container, which is around about a third of the way up the INE price level. So obviously the opportunity was spotted by an arb trader, which will probably be capitalized on moving forward, where they are buying the SGX contract for June and they are selling the INE contract for June. So you're essentially locking in, pending basis risk between the two exchanges, you're locking in the price between the sensibly higher INE price and the much lower FBX price. And it wouldn't surprise me that moving forward you get some kind of rash between those two exchanges as the volumes on the FBX develops. And that's really the key thing for us at the moment, is developing that FBX volume, because it has lagged quite considerably from the onshore contract. But basis what we hear in the market and how we've been developing this at Braemar over the past couple of months, we would probably see the FBX markets hopefully catching up to this. And then you might end up with a situation that already exists between something like Dalian iron ore and SGX iron ore. There's a very, very big arbitrage trade between those two things. And this is demonstrated. You see a massive tick up. This is taken from the Braemar screen. You had a slide earlier with the band slide that showed this as well, where you've got a quite substantial uptick in rates and futures contracts very, very recently. Who knows whether this is going to sustain itself? but you've got visibility on the rate that wasn't necessarily there before when the CME and SGX markets initially launched. And that's being worked on and being developed as we speak. And rather than going into examples, I think it's just really important to note how this all fits in line with whatever you're doing on the physical market. We've had everything from trying to frame hedging price on spot exposure, which is very, very straightforward. If you're a shipper, if you're a BCO, and you want to hedge against prices rising, you would buy a futures contract, and that ensures that if the prices do rise, you've got some kind of offset against that price. Likewise, if you're an ocean liner, if you want to say, well, I don't want the prices to go down next year, therefore I will be selling futures contracts. But in extension to that, the contract market in container freight is very, very diverse. You may have annual contracts. You may have situations where someone wants to renegotiate an annual contract with a liner. That's not necessarily a good situation for the liner, and the long run, probably not a good situation for the BCO either. You can use futures to essentially amend that price, to swap your physical price, your flat price, your fixed price for an index-linked price, and vice versa. Hopefully addressing some of the problems in the contract market that tend to exist in container freight on the physical market, where people tend to break contracts either way of that relationship. And that really draws on an initial point about the INE and why you would choose futures is performance of those contracts. All of these contracts on futures are cleared by central exchanges. Therefore, you have a contract that sticks. It does not break pending, a collapse of the exchange that hasn't happened yet in history, right? So you've got a really strong basis in which to hedge rates, which you may not find in the physical market. And finally, we've touched on this arbitrage with the INE. I would forecast that that's going to play a major role in where the volumes and the interest comes from internationally, and that's probably going to feed back into more volumes in the INE in the long run. So bit of a whistle-stop tour of how this works, but hopefully that gives you a good scope as to how you might look at things on the international markets. And my contact there, and I'll leave that with you and with Vincenz, so we can go through this at some point later. But yeah, that's it from me.
Okay, thank you very much, Peter, first of all. I think we have a few more questions, so we'll try and just run through those very quickly to make sure we don't let you wait here for too long. I'm just going to start perhaps with the first question here. We have one question for Johnson, namely, a lot of capacity is scheduled to be delivered in the second half of 2024. When do you think that this will push the spot market down again, especially on Asia to Europe trades, North Europe and Med?
Well, so my key point here tonight is very difficult to predict, and certainly I won't recommend to make a prediction just based on the headline capacity growth or drop. So that's one. And secondly is although sequentially is more capacity being added to the market. But we're also starting a seasonal change in the market, because container shipping typically, so we're going to have the peak season in the summer, so basically start in June and sometime could run all the way into September. So for Trans-Pacific, could even run into October, right? So although sequentially, yes, there will be more capacity, but then you also have a more volume coming in as well. So you cannot just look at the new capacity being added. And then one point to add also, the new capacity being added is not much larger than what we have seen year to date. Basically, up until early May, so we see that the year-on-year growth in capacity is actually up to 10% globally. So sorry, yeah, it says so many things, but in the end, it says you can't call it. So the whole point about using futures is hard to predict, right? So maybe next question.
Okay, perhaps do you want to take that one as well? We have
who are buying, you mean?
Yeah, so essentially I think the question here is, assuming I buy this August contract at $6,000 per 40-footer, and then the market hits 70,000 and I sell, who at that point is actually going to be the one buying that contract. So I think the idea here is, assuming you want to take you buy at 6,000, market goes up to 7,000, you want to take that $1,000 profit. Who is basically that idiot essentially that is going to buy the contract that is way overpriced? I mean, obviously you're expecting it to fall now. And I think here the idea really comes into play that the futures market benefits from having the widest possible range of people in the market. You want speculators, you want hedgers, you just want different market participants in that same market. And they all are going to have different views, different ideas of what is going to happen. So if you buy at 6,000 and you sell at 7,000, you might expect that 7,000, that's the highest it's going to go. There's no way it's going to go any higher. And so whoever buys at this point, well, good luck to them. But somebody else might have a very different view. And in a liquid market, you are going to have all these people in the same market. And so you're going to have these buyers and sellers. And so it ultimately means if the market price for that contract is 7,000, that means there are people asking to buy that contract at 7,000. So it's really essentially a fundamental principle of the futures market. For every person buying, there is somebody else selling. Otherwise, that market price doesn't exist. So if the market is at 7,000, that means there are buyers and sellers at 7,000.
That's, yeah, because I see these questions from Adrian and also from Emmanuel talking about the carriers' participation. So one, we are not aware any major liner participating. Secondly, even if there are liners participating, but the structure of the contract is totally financially settled. So it doesn't really matter, liner participate or not, that there won't be a shipping slot being offered at the settlement. So the instrument here is being introduced by Vincent and also by Peter is actually is the financial hedge. It's a go against, to hedge against the price volatility. But then the space and cargo, so you still need some level of enforcement to make the physical space and cargo meet. So, but then at least, because nowadays there's a lot of people talking about index-linked contract in container shipping. So one side of the contract do not want to take the volatility, but the other side want. Then this kind of instruments that the futures trading will come in pretty handy. But then still, there's the whole index-linked contract still has to be built on the idea that both sides eventually will honor the contract. So in the physical side, meaning the cargo owner will provide the cargo, and then the shipping company will provide the shipping slot.
Peter, is there anything you want to quickly jump in and mention?
I mean, I can say there are liners involved, absolutely. But as was mentioned, it's kind of a moot point. We do need everyone involved in the market to make the market work. But you've got everyone from freight forwarders to funds to BCOs, shippers directly to banks to all sorts of counterparties involved in this market already. So hopefully that provides a bit of, I guess, confidence as to who's actually involved. That's one of the main things we get asked quite a bit, right? So hopefully that answers that question.
Okay, so liners involved in the voice trade side, but yeah, the INE side, from what we know, there's no liner involved.
Yeah, perhaps that brings us to the next question, because ultimately, obviously, our hope is to get different parties to be active in both markets. So the question here is, are there any eligibility requirements for offshore participants? So I'm assuming that's participants outside of China or institutions to trade futures on the Shanghai Shipping Exchange. And does BANS act as a broker to offer direct access to the Shanghai Shipping Exchange? So perhaps just one thing to very quickly clarify, the Shanghai Shipping Exchange is not actually a regulated financial exchange. They are simply the index provider, and they are essentially just calling themselves an exchange, but for different reasons. So the contract itself is actually traded on the Shanghai International Energy Exchange, which is a regulated futures exchange. But to specifically answer your question, essentially international participants are able to trade on that exchange. For account opening, these sort of things, there obviously are some more detailed requirements. Perhaps it's easier to answer that in a perhaps one-to-one conversation at some point or by email. But fundamentally, there's nothing prohibiting overseas participants from accessing that market. And BANS Financial, for example, is able to act as a broker for that exchange, as well as a clearing broker, for example, on the CME and SGX as well. So the idea would be that, again, a market participant could access both markets and see basically, especially on the Asia to Europe contracts, which contract could benefit the most, or if there is an arbitrage opportunity there, which, I mean, Peter mentioned right now, there certainly is, at least based on what it looks like in the market. You are able to access both markets essentially. And yeah, perhaps just very quickly, another question here. As a freight forwarder, my objective is to obtain, sorry. Yeah, so essentially the futures contracts here are purely financial contracts. So if you hold the contract until expiry, you are not going to be guaranteed space on a ship, basically. You are going to be financially compensated for your position. So that means if the market today is at 1,000 and you buy the contract and the market goes to 2,000, then essentially you would make money on that contract, whereas the person that sold the contract and your counterparty would essentially lose money on that contract. And ultimately you would calculate based on the contract value, how much money exactly has to change hands, and the exchange ultimately makes sure that you receive your financial profit, or you essentially pay out your loss. So it's purely financial, and you would still need to make sure that you arrange physical cargo space. So the purpose of these futures contracts essentially is primarily as a tool for locking in a price, for example, if you are a hedger, or as Peter mentioned, there are some other ways of essentially using these contracts, depending on whether you want a fixed or floating price, essentially, and depending on what exactly your physical cargo contract basically says. Peter, do you want to mention anything in that regard?
Yeah, I mean, it's a question we get from freight forwarders very, very frequently, right? It's just a question of getting your mind around, as you say, cash settlement versus actual physical delivery of capacity to a customer. You're ensuring that your financials are in order so you can deliver capacity. I'll give you an example. Let's say a really, really bad market for delivering capacity, say COVID period, top of the COVID market, very, very difficult to get capacity from anyone because the demand is so high. You are inevitably paying the highest possible price from someone that actually has capacity, which generally hovers around or is in correlation to wherever that spot market is. So if you are hedged via a futures contract that settles against the spot market, you are you can't really say ensuring, you're offsetting your own financials. So I would pay, or I would buy at $4,000, the market shoots up to $8,000. I'm receiving $4,000 per container, let's say, but that means I can deliver to a customer the capacity they require. And it's my choice to say I can deliver it to you effectively at $4,000 per container, even though the market's at $8,000, which is a really attractive proposition if you're trying to deliver capacity in that kind of market. Or you can pay up to a liner when you need to, because you've got that receivable in the back end to be able to deliver that capacity to a customer. So that's the way we would view it.
All right, thank you. Yeah, then we have a few more questions here. One regarding these slides. I think it's just something that may have been unclear. The idea is that, yes, there is a $136,000 loss on the future side, but you also have a $100,000 profit on the physical side. So your net loss essentially would be 36,000. So the offset is not quite one-to-one. So that's for Andrew here. Lastly, the correlation between the INE EC and the SGX, I think Peter already mentioned, it's actually very, very strong. So the correlation between the underlying index is definitely there. And that's why you technically have this arbitrage opportunity. If you are able to access both markets, you can go in there and basically sell one, buy the other, with the expectation that unless something really dislocates those two markets, they should ultimately converge to the same price level at least. And the detailed settlement, it's a bit complex because the indices aren't calculated in exactly the same way. So perhaps I have a bit more detail in the slides, so I'll send that out obviously later. But if you want a bit more information from us on that, or Peter as well, we're definitely happy to chat with you later anytime. So just feel free to reach out to us by email, or we can set up a call to discuss this in a bit more detail.
And then why no options?
Yeah, so with options, ultimately, you're right. On the INE, for example, you might say, okay, why are there no options yet, given that the volume is strong? I think ultimately, it's important for the futures market to develop first and to sort of be accepted before you allow options, because ultimately, if you open up a market a bit too early and there is no volume, then people are going to be very hesitant to be the first one to essentially go into that market and provide that volume. So you want to make sure that the futures market is mature first before you ultimately provide options. Now, if you look at other types of futures contracts, on many of them, you nowadays have options. So it's very possible that at some point, as these markets develop further, options contract could become available. But right now, based on what we've heard at least, it's not under consideration from any of the exchanges. I don't know if you've heard anything, Peter.
It's so over the counter, away from the exchange, there is a discussion going on. But as you say, you need a mature market. You could even say, look, well, we could offer, options contracts over the counter for institutional investors on the FBX, right? And you'd use the INE we call it hedge the delta. If you don't understand, options essentially means whoever's giving you that insurance is managing their own risk on that insurance package, which makes sense. But then you've got an issue, how does someone reconcile something in US dollars on an option against a RMB denominated underlying? So that has to be worked out. There are the conversations happening in the background with the end users, not necessarily with the exchanges just yet.
I have heard in China, the brokers actually writing options to their clients.
Yeah.
So there are some forwarders that they don't want to trade on futures about taking the entire risk. So they want to limit it. So for example, they want to short. So the risk is unlimited, right? As you know, so you short futures. But for buying a put options, then the risk is limited to the value of the option, the put. So, but that kind of options, it seems to be only offered by broker to their clients, and it's not publicly traded or exchange cleared.
Yeah, so at the moment it's still OTC. That means, again, you essentially get away from the idea that the exchange is the counterparty, because the thing that makes these futures a safe tool for trading is that the exchange is a regulated entity that is going to make sure that each counterparty is ultimately going to get paid. And if you're doing this OTC, again, it's possible if you can find the right person to write you that contract, but ultimately you are going to be facing that counterparty again. You have nobody to protect you. And if ultimately they are unable to meet their contract requirements, you might not get paid. So it's possible in the OTC market, but slightly more complex. And on the exchange traded side, at least right now, there's nothing yet here. Then we have one last question from Andrew. Do we truly believe volumes will be strong in Q3 and Q4 2024 relative to the capacity coming online? I believe volatility in the markets will continue and if not increase second half of 2024, given so many geopolitically active events, elections, global fragility of the consumer bases, and company debt and pressures on margins. I think that's probably directed to Johnson here.
Yeah, well, so usually it's a peak season. So we see the sequential, so we tend to believe there will be sequential pickup in volume, but if they will be stronger to absorb all capacity, is to be seen. But the demand side, for the demand supply for container shipping, now I'm breaking the faith in the supply projection, because they have, I'm calling the headline projection or supply or the new ship delivery not being reliable. But the demand side usually is even harder to call. So if there will be strong demand or not. But anecdotally, though, early this month, I have met a group of BCOs. They're mostly European importers. So one takeaway from the meeting is they do see very strong order for them. And then they also do not think that they themselves have purposely advanced the order to try to sidestep the peak season. So they themselves also quite surprised about the order. So I mean, the group of people that I met, they're mostly merchandisers, and then some of them the ocean procurement people. Yeah, they do surprise, because one thing they know is that their own inventory is low. So and then they think that the European consumer may face less inflation pressure this year than the previous 2 years. So hence they think that maybe there's a slightly stronger purchasing power, and also they themselves need to replenish their own inventory. So, but anyway, Andrews, I mean that the whole point about tonight is it's not so easy to call the future. So, but I mean your questions are all valid. So, but it's just difficult to really for us to decide if the Fed rate will stay, high or not. But we do have I mean from Linerlytica we do things we have said many times we see that the Fed rate could actually stay high for this peak season. So that's I mean, if you ask us, we will say so. Maybe 60% of us believe that will happen that way, and then 40% of us want some hedges. And then the last one.
Okay, yeah, I think perhaps we're gonna make this the very last question. I don't want to keep you here any longer. I know your time is valuable, so we'll finish this question, and then I thank you very much everyone for joining. So yeah, you're gonna get the slides, and for any further questions, feel free to reach out. You got all our contacts. You got Peter's contacts as well.
Yeah.
We're more than happy to chat with you later.
The recording will be available.
Exactly. We'll make the recording available later as well, and the slides. So yeah. And for Srimali, Johnson, do you have anything you want to add on to that as well?
We're good. Just I mean, you get Peter's contact, your contacts. I think Linerlytica's editor's email address is also in the slides, and people see it. So I think we are good.
Okay, yeah. So Srimali, we'll get back to you by email. I've noted down your questions, so we'll write you up a quick response there.
You mean the 20-footer thing?
Yes.
Equipment's in shortage, so I mean that's I think I don't know how long it will last. So definitely now the box manufacturer said that the order books are full until August.
All right. Yeah, so thank you so much for joining. Thank you so much for your time. Thank you, Peter, very much for contributing as well. Thank you, Johnson. And yeah, we're looking forward to seeing you in the next webinar.
Good stuff. Thank you.
Thanks, Peter.